Helen Lau is an analyst at UOB Kay Hian, joins me now in the studio, having written a report. Big question. Thanks for joining us.
Thanks.
Is China running out of coal?
I think so. I think for the, in the second quarter, there's a big risk that China may running out of coal because of the low inventory at the port and at power plants. So we think at the same time the demand is very strong. So that's why the government has asked, there's a blackouts, ahead of summer. So that is very unusual. So that's why we think that is mainly because of the China is really running out of coal. So
it's usually 15 days consumption, but now
yes.
it's 9 days. Can you explain the...
Yeah, I'm talking, of course, on average, it's like around 14 days, at power plants. But in the certain provinces, the inventory at power plants is dropped to, such a low levels. So that's why we think a lot of the provinces, especially in the eastern China, is facing, this kind of shortage in electricity. So, we see these blackouts in power.
Now, coal accounts for 70% of electricity in China.
Yes.
So what are they going to do if the worst case scenario happens?
Well, it will not be able to solve this, shortage in any time, in the short term, because, in the first quarter, Chinese new stored power capacity has reduced compared to last year. So China needs to build more of these, firepower plants. That is one thing. And secondly, they need to increase the power prices. But China is concerned about inflationary pressure. So this may not increase the power price at any time soon. So that's why I think in the short term, they need to build more power plants and also need to increase the power prices in order to solve this problem.
Basic economic principles. Demand is huge, supply is minute, it would seem, so therefore prices have to go up.
Yeah.
The government, as you were saying before, are going to cap prices.
Yeah.
How long can they cap them for? I mean, what impact is that going to have on the pricing of coal?
I think, because China needs to control this inflationary pressure, so they are very reluctant to increase the power prices. Just a month ago, they slightly increased the power prices by only 1 cent for some power plants. But that is not enough. A lot of power plants are in the red. So they need to substantially increase, power prices further in order to offset the increase in the power prices, in coal prices. So, I don't think this will happen at any time soon.
But a knock-on effect, coke and coal is required to make iron ore, etc., to make steel.
Yes.
So therefore, it really is across the entire industry, isn't it, of steel, iron ore, that it could be quite a damaging impact.
Yes, that's right. Yeah, because for coking coal, there's that's different because China, because the coking is also in shortage in China, so there's also a lot of demand in coking coal. Coking coal price is also going higher, so also a lot of steel companies are in red because of the higher coking coal price and the iron ore prices.
Now, Yanzhou coal today falling 7% temporarily, but it's still your favourite stock, isn't it?
We have already switched our topic from Yanzhou coal to Shenhua.
Right.
Because the reason is because we think going forward, China may may regulate the power supply to the steel companies, so the steel production may reduce. So therefore, the demand for coking coal may be eased. Okay, so therefore we switched from Yanzhou coal to Shenhua because we think the upside for coking coal for the time being may limited compared to thermal coal. So that's why we switched, this recommendation.
Thank you very much for joining us. Helen Lau there, joining us there from UOB Kay Hian Ltd.
Thank you.
Thanks for joining us there. Very interesting indeed, quite worrying story for China. Now,